Options income strategies on individual equities are designed to win most of the time, but occasionally the stock will move against your position. Hi, I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and experienced options traders know how to use options in a variety of ways to express their directional opinion on stocks or other optionable kinds of assets. But what if your options trade goes wrong? Is there a way to salvage a trade that goes against you initially? In this video, we're going to run through a simple technique to fix a broken options trade. So if that sounds familiar, then stick around because I think you're going to find this useful. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so we're obviously in the midst of one of the most bullish markets in history, and as a result, almost every dip is being bought by this market, which seems to have an insatiable appetite for equities at the moment. And obviously, Amazon has benefited immensely from this pandemic as people are driven online to shop to avoid social contact. And as a result, the stock bounced off of its mid-March lows in the 1600s, and by late August, the stock had doubled, rallying above 3,400. Now, at one point during Amazon's rally, as you can see, the stock had reached the 3250 level in July and had trouble getting past that, running into resistance at that level numerous times until it finally broke out above that level in mid-August. Now, very often, once resistance is broken through, that same previous resistance level acts as support in many cases. So in situations like this, proprietary options traders like to get long at those levels. So one of the more interesting techniques that they use is to actually sell a put option at that support level. Now, the reason they would do something like that is because of the nature of put options themselves. And as most of you know, a buyer of a put option has the right to sell 100 shares of a stock he owns at any time before the option expires at what's called the strike price of that put option. And he can do so no matter how long the stock goes below that strike price, effectively creating a floor on how much he can lose on that stock. The seller of the put collects what's known as a premium for providing that protection to the put buyer. And if the stock closes above the strike price of that put on the day it expires, the put seller just pockets the premium that he received from selling that option. So the concept with this trade is that if you sell the put at support, and that support is likely to hold in the trader's estimation, then the trader will make a profit equal to the full premium he received initially for selling the put. And so let's say on August 27th, when Amazon was trading above 3,400, the trader sells a put at 3,250 for $63.57, assuming that Amazon will hold support and that put will expire worthless. So let's look at the cash flow of this transaction so you can understand why he would make this trade. And as you can see from the calculation, the trader sells the option for $63.57. But remember, a put option relates to 100 shares of stock. So you have to multiply that by 100. And so at the outset of the trade, we'd received $6,357. Now, before we get into how this trade plays out, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not that often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now we've entered into this short put trade and collected $6,357 up front. So now let's move to 1 week later on September 4th. And as you can see, it turns out that our premise was wrong. And in fact, Amazon did not hold that support level at 3,200 as we had anticipated. And so at that juncture, we have two fundamental choices to make. Many swing traders at this point would simply say, hey, I was wrong. Amazon didn't hold that former resistance level at 3,250, which we thought would act as support. And so we're wrong and we'll just hit out of the trade and take a loss. And that is certainly a viable approach, but there is another approach that can work very well in these situations. And that starts out by trying to determine a secondary level of support. And in this case, the trader observed that Amazon held that 2960 level several times during the summer. And so armed with this information, the trader can then elect to buy what options traders refer to as a diagonal spread. In this case, that involves buying back the short put at 3250, expiring in November, and rolling that down to the 2960 put, almost 300 points lower to the new support level that we've identified. Now let's take a look at the cash flow of that purchase so you understand what's happened here. Okay, so remember, we originally received the 63.57 for selling the September put, and now because the stock is sold off to below the strike price of that put, now the put seller really has to load extra premium into that option because now the chances of the stock closing below 32.50 on the day it expires have gone up substantially. I mean, after all, if it expired today, there'd have to be a payoff on that put because the stock has dropped below the put strike price. And we've got the future to deal with as well until the option actually does expire. So therefore, the cost of buying that back and closing it has now skyrocketed to $17,645. However, when we go out to the October expiration and sell the 2960 at that new support level, we bring in $12,452, which results when we net it all down to a reduced cash flow level. But nonetheless, it is positive cash flow in the amount of 1164, which if the stock holds that 2960 support until October, will win this trade. Now at this point, let's move forward to September 21st. And as you can see, Amazon also failed to hold the 2960 level. And so again, we could close the trade if we so desire at a loss, but as you've seen, there is another option. So this time, let's look again for yet another support level. And as you can see, towards the end of June, Amazon was meeting resistance at 2,800. But in early July, it broke out from that level and began to rally strongly throughout the rest of the summer. And so it wouldn't be illogical to think that the former resistance level might hold. And so again, we move out this time to November. And as you can see, we buy back the 2960 October put and roll it down to the 2,800 November put, right at that former resistance level. So now let's take a look again at the entire cash flow history of this trade at this point. And as you can see, we've gotten in the original cash from selling the first put in this campaign. We've taken into consideration the roll from the September and October put, and now adding in the impact of buying back the October put and selling the new November put at the lower support level of 2,800, you can see that we now have a positive cash flow of 3,180. Yet the market is now trading at 450 points below where we first started, what we thought of as a bullish trade. Okay, so now let's move out to the final day of November. And that put option that we own on that day, well, that expires worthless. And that is because Amazon is trading up at 3,100. And in fact, it never really retests 2,800 after that. So what happened at this point is that the music finally stops and that put down at 2,800 just expires worthless because no one is obviously going to sell their shares of Amazon at 2,800 when Amazon itself is trading up at 3,100. And so what that means is that the net cash flow of $3,180 that remained after selling the original put and buying all of those diagonal spreads resulted in a net profit of $3,180, despite Amazon selling off and never actually coming back to its original price level by the end of the trade. And remember, this was originally supposed to be a bullish trade, yet we were able to salvage it and make that $3,180. And so what I'd like you to take away from today's presentation is that there is a way to use options to express a long position on a stock without buying the shares themselves. And if the trade fails, there's a way to fix it that is quite viable because you can always seek another support level. And most of the time, one of those support levels will eventually hold. Through the use of diagonals, you have the option to roll down and continue your campaign if you think that ultimately the stock will support and continuing the trade is the best ongoing use of your capital. Professional options traders have many techniques that they can use, like buying diagonals, to ultimately win trades if your basic thesis on a stock remains relatively the same and you just may need more time for the market to fall in line with your general trade thesis. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 other real world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.